For every speculator who has successfully ridden a great trend, there comes a moment of profound and terrifying uncertainty. It is the moment when the music, which has been playing so beautifully for so long, begins to falter. Is this just a momentary pause, a natural and healthy reaction before the next great advance, or is it something more sinister? Is it the end of the move, the quiet, almost imperceptible beginning of a catastrophic reversal? To answer this one question correctly is to separate a great and lasting victory from a tragic round-trip journey back to break even, or worse. It is the single most important and most difficult challenge in all of speculation, knowing when the trend is about to reverse. Jesse Livermore dedicated his life to solving this great problem. He was not a man who believed in guesswork or in selling simply because a stock seemed too high. He knew that such an approach was for the amateur, the man who is perpetually shaken out of the great moves too early. He sought a signal, a clear, unambiguous, and reliable indication from the market itself that the underlying conditions had changed, that the great tide which had carried him so far was finally beginning to turn. He was a master at reading these subtle but powerful signs, and while he used a collection of tools, there was one great strategic signal that he prized above all others. This was his secret for anticipating the end of a great bull or bear market long before the crowd was even aware that the danger was near. It was not a complex formula, but a profound and simple observation, a principle so logical that once understood, it can serve as a speculator's most powerful early warning system. It is a signal that is not found in the frantic day-to-day noise of the market, but in the changing character of its most important players. This is the story of that number one signal, the great secret to how Jesse Livermore knew, with an almost uncanny precision, when a great trend was about to die. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Before we can understand Livermore's great signal, we must first unlearn the amateur's idea of a market top. The novice expects the end of a great bull market to be a single dramatic event, a spectacular blaze of glory where the price makes a final explosive peak and then immediately collapses. This, Livermore knew, was a dangerous myth. He wrote, with the authority of a man who had witnessed countless market cycles, "A market does not culminate in one grand blaze of glory. Neither does it end with a sudden reversal of form. A market can and does often cease to be a bull market long before prices generally begin to break." The end of a great trend, he understood, is not a loud, violent event. It is a slow, quiet, and often invisible process. It is a subtle and gradual shift in the market's internal character, a slow erosion of the buying power that once seemed so invincible. The great final peak is often reached on a wave of public euphoria, while the smart money, the insiders, and the great operators have been quietly distributing their lines for weeks or even months beforehand. The secret, then, is not to look for the final explosive top, but to look for the first subtle signs of this covert, inside selling. This brings us to Livermore's number one signal, the earliest and most reliable of all warnings that a great bull market is nearing its end, the failure of the market leaders to continue their advance. He knew that every great trend is led by a small handful of dominant stocks in the strongest industry groups. These are the generals of the market army, the stocks that move first, fastest, and with the greatest force. Their health, their vitality, their ability to continue making new highs, is the ultimate barometer of the entire market's condition. As long as these generals are leading the charge, advancing with vigor and conviction, the bull market is safe. But the moment these same leaders begin to falter, the moment they lose their upward momentum and refuse to follow the broader market into new high ground, a profound and critical warning has been issued. It is a sign that the great, informed capital that propelled the advance is no longer buying and may, in fact, be quietly selling. It is the first faint tremor that precedes the great earthquake. The story of how he called the great market top of 1916 is a perfect textbook illustration of this principle in action. Livermore had been a great bull throughout the war-driven market, and he had accumulated a massive fortune on the long side. But he was not a man to be blinded by his own success. He was in a constant state of vigilance, watching for the first signs that the great trend was complete. That sign came not from the market as a whole, but from the behavior of its former champions. He noticed that the very stocks that had been the undisputed leaders of the entire 2-year advance, the great steel and motor stocks like U.S. Steel and Anaconda, had stopped making new highs. While the broader market averages carried by a final speculative flurry in secondary stocks were still inching upward, the generals had halted their advance. They would have reactions, sharp and sudden declines, and then their rallies would be feeble. They would fail time and again to reach their old highs. They had lost their leadership. Livermore, the master tape reader, saw the effect with perfect clarity. The generals were falling. But one of his great contemporaries, Richard Wyckoff, developed a system to map the cause of this very phenomenon. While Livermore was the supreme speculator, acting on the market's behavior, Wyckoff was the supreme analyst, who codified the science of distribution. He showed how the quiet, persistent selling by large operators is what causes a leading stock to lose its upward momentum. Livermore saw the symptom. Wyckoff diagnosed the disease. To truly understand the internal mechanics of a market top, the logic of supply and demand that explains why leaders falter, we invite you to subscribe to our new channel, Richard Wyckoff Trading Methods. The link is in the description below. To the amateur, the action of these former leaders was confusing. The news was still good. The dividends were still being paid. But to Livermore, the message of the tape was clear, simple, and ominous. A bull market cannot exist without its leaders. An army cannot advance if its generals have been shot. The weakness of the former champions was an infallible sign that the great, informed money was now being distributed, not accumulated. He did not need to know the reasons. The fact of the behavior was all the information he required. He did not turn bearish on the entire market overnight. His action was a model of strategic, methodical patience. He began by selling out his long lines in the very stocks that were showing this profound weakness, the faltering leaders. He then took the next logical step. He began to initiate short positions in these same stocks. He was not guessing at the top. He was acting on the confirmed, registered evidence that, for these specific stocks, the bull market was already over. He would at the same time continue to trade on the long side in the secondary lower quality stocks that were experiencing their final euphoric run-up. But his primary campaign had shifted. He was slowly, quietly and methodically moving his great capital from the long side to the short side, his actions perfectly mirroring the covert distribution of the great insiders. He was preparing his lines for the great bear market that he now knew was an inevitability. This, then, is the great #1 secret. It is to focus your attention not on the noisy, confusing action of the market as a whole, but on the clear, simple behavior of its undisputed leaders. It is to have the courage to trust the message of these leaders, even when it seems to contradict the action of the broader averages. It is to understand that when the strongest soldiers begin to fall, the battle is already lost, even if the rest of the army has not yet begun its retreat. This is the earliest, the most reliable, and the most profitable of all reversal signals. Having received the great strategic warning, the faltering of the market's undisputed leaders, The master speculator now shifts his focus from the panoramic view of the entire market to the microscopic examination of the individual stock. The generals have sounded the retreat, but the professional requires a tactical signal before he commits his own forces to the new direction. He needs a clear, unambiguous, and confirmed sign that the trend in the specific security he is watching has officially turned. Jesse Livermore, through his relentless study of the tape, identified two such tactical signals, a powerful 1-2 punch that transformed his strategic observations into precise, actionable, and highly profitable trades. The first of these tactical signals, the second great reversal signal in our sequence, is a phenomenon we can call the failure to rally, or, as he would describe it, the reaction without a rally. To understand its power, one must first recall the normal, healthy rhythm of a bull market. A strong stock in a primary uptrend moves in a distinct pattern. It will have a strong advance, followed by a natural reaction, or pullback on lighter volume, and then it will resume its advance, pushing into new high territory. This is the heartbeat of a healthy trend. The failure of the stock to complete this pattern is the first sign of a profound illness. After a long advance, a leading stock will inevitably have a reaction. The amateur, if he has held on, watches this pullback with anxiety. The professional watches it with intense clinical interest. He is not concerned with the decline itself. He knows it is normal. He is concerned only with what happens next. The great and critical question is this: what is the character of the subsequent rally? Does the stock, after its decline, find its footing and begin to advance again with its former vigor and power? If it does, if the rally is strong and it carries the price to a new decisive high above its previous peak, then the bull trend is confirmed. The heartbeat is strong. The advance is still healthy. But if the rally is weak, if it is anemic and labored, if it struggles on low volume, and most critically, if it fails to surpass the previous high, then a definitive danger signal has been flashed. The upward momentum is gone. The buying power that once so easily propelled the stock to new heights has been exhausted. This failure to rally is a profound statement from the market itself. It is a declaration that the sellers, at a price level lower than the previous peak, are now equal to or stronger than the buyers. The line of least resistance, which had been so clearly upward, is no longer so. It has either flattened into a neutral state of indecision, or more ominously, it has begun to tilt downward. Livermore did not need to know the specific reason for this weakness. The fact of it, as registered on the tape, was all the information he required. To hold a long position after such a clear demonstration of weakness was, in his view, an act of pure, unadulterated hope. It was to ignore the market's own factual verdict in favor of one's own wishful thinking. This was the precise moment that the professional speculator, his mind free from emotional attachment, would begin to liquidate his long line. He was not guessing at the top. He was acting on the first confirmed piece of evidence that the great upward move had run its course. This brings us to the third and final signal, the great mechanical confirmation that removes all doubt and all room for debate. It is the point of no return, the market's own official announcement that the old trend is dead and a new one has been born. This is the decisive break of the last pivotal point of support. Having failed to make a new high, the stock, now in a state of profound weakness, will begin to decline once more. Its trajectory is now aimed at a critical price level, the extreme low point of its last natural reaction. This price level, this previous reaction low, is, in Livermore's system, a pivotal point of the highest importance. It is the last line of defense for the bull trend. It is the floor upon which the entire upward structure has been built. As long as the price remains above this level, there is still a glimmer of hope for the bulls. The trend is sick, but it is not yet dead. But the moment this floor gives way, the entire structure collapses. Livermore had a precise mathematical rule for this confirmation. It was not enough for the stock to simply touch this great support level. It had to decisively and powerfully break below it. His rule was that the trend was only officially reversed after the stock had declined 3 or more full points below the low of that last natural reaction. This was not a minor dip. It was a confirmed catastrophic failure of support. It was the signal that the sellers were now in complete and total command. When this signal was given, the time for caution was over. The time for decisive, aggressive action had arrived. It was the final, absolute, and non-negotiable command to exit any and all remaining long positions. More than that, it was often the perfect psychological moment to initiate a new and powerful campaign on the short side of the market. The old king was dead. The new king, the great bear trend, had just been crowned. To be on any other side than the short side was now to fight an irresistible force. These 3 signals, then, form a complete, sequential, and profoundly logical system for identifying a major market reversal. It begins with the great strategic early warning, the failure of the market's undisputed leaders to continue the advance. This is the first sign of sickness. It is followed by the first tactical warning on the individual stock, the failure to rally, the inability of the stock to make a new high after a reaction. This is the sign the sickness is advancing. And it culminates in the final decisive confirmation, the break of the last line of support, the reversal pivotal point. This is the pronouncement of death for the old trend. This system is not a matter of guesswork. It is a matter of patient, dispassionate observation. It is a method for reading the market's own story as it is written, tick by tick upon the tape. It requires no inside information, no complex analysis of earnings, and no emotional opinion. It requires only a deep understanding of the market's natural rhythm and the discipline to act without hesitation when that rhythm is broken. This was the great secret that allowed Jesse Livermore to navigate the market's treacherous turning points with a level of confidence and precision that made him a legend. To truly understand the mind of the man who mastered these principles, to witness the epic market battles where this very plan was put to the ultimate test, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. The master speculator, having received the first 2 great warnings, the strategic failure of the market's leaders and the tactical failure of his individual stock to rally, now stands at the final precipice. He's on high alert, his hand poised, his mind free from the bullish enthusiasm that still clouds the judgment of the crowd. He has seen the sickness in the trend, but he requires one final, irrefutable piece of evidence before he will pronounce it dead. This is the third and ultimate signal of a market reversal, the great mechanical confirmation that transforms a high-probability suspicion into an actionable certainty. It is the moment that all hope for the continuation of the old trend is extinguished by the cold, hard mathematics of the ticker tape. This final signal is the decisive break of the last significant line of support. In the precise scientific language of Jesse Livermore, this was the violation of a reversal pivotal point. To understand its power, one must visualize the structure of a great bull market. It is not a straight line, but a series of ascending steps. Each advance creates a new high, and each subsequent healthy natural reaction creates a higher low. This series of higher lows forms a great upward-sloping foundation of support upon which the entire trend is built. The last of these reaction lows, the most recent step in the staircase, is the most critical of all. It is the final line of defense for the bull army. As long as the price of a stock remains above this last great support level, the primary upward trend, while it may be wounded and faltering, is not yet officially dead. There is still a glimmer of hope that the buyers will regroup and make one final heroic stand. The amateur speculator clings to this hope. He sees the price fall back to this level and he thinks it is a bargain, a great opportunity to buy the dip. He does not see that he is standing on the edge of a cliff. Livermore, in contrast, saw this level not as an opportunity to buy, but as the ultimate point of decision. He was not interested in guessing whether this final line of defense would hold. He was interested only in the market's own final verdict. His rule was absolute. If the stock, after its failure to rally to a new high, now declined with enough force to decisively break below this last great support level, it was the final, irrefutable signal that the trend had reversed. He was not content with a minor, fractional breach of this level. He had a precise mechanical definition for a true, confirmed break. The stock had to decline by 3 or more full points below the low of that last natural reaction. This was not a small, insignificant dip. It was a catastrophic failure of support. It was a signal of such power and finality that it left no room for doubt or debate. It was the market's own official declaration that the sellers had not just gained the upper hand, they had won the war. The line of least resistance was now, and for the foreseeable future, irrevocably downward. When this signal was given, the time for all caution and all hesitation was over. It was the moment of supreme, decisive action. For the speculator who was still holding a long position, it was the final, non-negotiable command to liquidate, to sell everything without a moment's regret, and to preserve whatever profits remained. To hold on past this point was not speculation. It was a form of financial self-immolation. But more than that, for a master speculator like Livermore, this was often the precise psychological moment to complete his great pivot. It was the signal to unleash the full force of his capital on the short side of the market. He was not just exiting a dying bull market. He was entering a newborn bear market at its very inception. He had waited with the patience of a general for the enemy's final line to break, and now he was leading the charge into the newly conquered territory. His legendary shorting of the great 1907 and 1929 markets was not the result of a single brilliant prediction of a crash. It was the logical and inevitable culmination of this three-step process. He first saw the great leaders of the day, the Union Pacifics, the Steels, the Radios, begin to falter at their highs. This was his great strategic warning. He then observed their failure to rally after their first significant reactions. This was his tactical confirmation of weakness. And finally, he waited for them to decisively break their last great support levels, his final mechanical trigger to unleash his great bear campaigns. He did not guess the top. He identified it through a process of irrefutable accumulating evidence. These three signals, then, are not independent events. They are a sequence, a logical and unfolding story told by the market itself. The failure of the leaders is the first chapter, the foreshadowing of the tragedy to come. The failure to rally is the second chapter, the rising action, the confirmation that the protagonist is fatally wounded, and the break of the final support is the final dramatic chapter, the death of the old trend and the birth of a new one. The master speculator is the man who knows how to read this story, who understands its timeless structure, and who has the discipline to act at the climax. This is the great secret to spotting a reversal. It is to understand that a trend does not die in a single violent moment. It dies slowly, from the inside out. It is a process of decay, of the gradual erosion of buying power and the quiet, persistent assertion of selling pressure. The signals that Livermore mastered are the observable symptoms of this decay. They are the market's own diagnostic tools, available to any speculator who has the patience to use them and the courage to trust their findings. The amateur who is looking for a single, easy answer will always miss these signals. He is listening for a loud, obvious gunshot, and so he does not hear the quiet, subtle turning of the lock. The professional, in contrast, is a student of these subtleties. He knows that the greatest and most profitable information is not shouted from the rooftops, it is whispered by the tape. To adopt this method is to transform speculation from a game of emotional, hope-fueled guesses into a calm, disciplined, and business-like pursuit. It is to accept that the market is a puzzle, but a logical one, a puzzle that will reveal its own solutions to the diligent and observant student. It is to understand that the greatest profits are not made by predicting the future, but by correctly interpreting the present. This was the source of Livermore's power. He was not a fortune teller. He was the greatest and most successful tape reader who ever lived.